Okay, welcome everybody to episode 117 of the Volatility Barometer podcast. New backdrop here. You've probably noticed it is a little bit different. I am in Dubai now. I try to back and forth between Taipei for some of the year, Dubai for some of the year, a little bit of travel throughout the year. But I am back here. Unfortunately, my furniture has been a little bit slow. It's not arrived yet. So I'm just going to stay in a hotel for a week because I do have to shoot videos. And I do think that even though this is maybe a little bit annoying, it's a lot better than being in an echoey room in a completely empty apartment. So this is the best I could do. And for me personally, this is fine. Those lights back there, that's the night golf at the Emirates Golf Club, which I am a member at. I hope to play some golf when I'm here, but it is mostly a business trip. So we've got a good show planned today. Unfortunately, just spoiler alert, I am going to be insulting a large swath of the financial industry today. But it's not all bad because when I get through the first math equations and basically proving my point, I am going to talk about some practical applications, both from the client perspective to get more out of your financial advisor if you choose to have one, and also speaking to the sort of good financial advisors out there. While it is probably a smaller percentage than people realize, there is a way to take what I'm going to say and actually accelerate your own business and do really well, despite the fact that this is going to look like pretty grim numbers. So not all bad. Give me a shot. And if you do know financial advisors, or if you're on social media and you happen to have some followers, go ahead and fire this link off to them, because I think that knowing how they respond to it probably will tell you quite a bit about their own quality in their industry. So I think you'll know what I mean when we get into this. And then I'm just going to make a judgment call whether we do the chart blitz for section 2 or not. If this goes a little bit long, I'll keep an eye on the time, and we might just get right into the open Q&A. So of course, you can start putting your questions in the chat now. I will get to those. I will answer all of them soon. Hopefully some of them talking about the work that I'm going to present here. But of course, it can be absolutely anything. And of course, as always, I don't do any ad reels. I don't talk to any sponsors or companies. I'm not going to be selling you anything here. But I would ask if you could give the video a like for me. It does sort of juice the YouTube algorithm, make me look a little bit more popular. So that would be much appreciated. But let's actually get into this. So the first thing that I want to talk about is sort of the place where this all began for me. This live stream today is sort of the culmination of, I don't want to say an argument. I would say on my end, I was certainly polite the entire time, so I wouldn't say it's an argument. But from the other person's perspective, he was being quite disrespectful. So I thought I would actually go ahead and do the full live stream and explain the point. And, it's not rocket science. I think once you see it, you'll realize it's pretty basic stuff, but you know how people are online. But anyway, a few weeks ago, there was this guy here who was posting a few things about the actual cost of financial advisors being much more than people realize, and sort of not understanding that intuitively, even though you're only paying a 1% fee, for example, that over time, when you compound that, it can actually add up to a very large sum of money. And a lot of people were being very critical. Of course, you get people like this with a bunch of letters behind their names being very critical. But I just sort of did, the average Twitter, it is X, but I'll probably always call it Twitter. I did a little drive-by saying, okay, well, his formula is incorrect because this person actually posted basically a future value formula that doesn't really apply to the equation. And I said his formula is not relevant, but his conclusion is actually correct. Financial advisors on average do cost investors about 35% more of their long-term capital growth. And then, of course, this set off a few people to respond to me, mostly this Daniel guy. I'm going to call him my friend Daniel here. He was quite triggered by the whole thing, and we went into this really, really long back and forth where he was demanding proof and example. So I actually linked one of the articles that I had written a while ago. This is, well over a year ago, but I linked an article where I actually reached these conclusions. And in this article, I can actually prove very simply that it is true. And I think in general, that is sort of the issue that, first of all, there's millions of financial advisors in the world. And of course, they are always going to be very protective of their own industry and their own job, their financial livelihood. That all makes sense. But there's also a problem on the client end that they do sort of fall victim to this idea that It's very easy for someone with a finance degree and a whole bunch of letters behind their name to just say, no, you don't understand the math. Like, actually, it's only a 1% AUM and it's actually a very small fee. But what we're going to get you is, we're going to help you out with all these things. And it's actually going to be presented quite well. And the client comes away just kind of nodding their head going, well, yeah, I mean, that's 1%. How bad could it be? And they don't really know anymore. But as I'm going to show, it's not 1%. It's an actual very, very large chunk of a person's wealth. So the first thing that we're going to do, I just want to go through the numbers again so people know where this is coming from. It's actually extremely basic stuff, right? I'm not revealing any secrets here. I'm not some genius with the math. This is something that honestly, like, one of the things that kind of surprised me a little bit when I got into this quasi argument online is that I was actually under the impression that this was complete common knowledge in the financial industry. What I'm about to reveal, I thought everybody knew this. I was actually quite surprised that a financial advisor with so many certifications was acting like they'd never even heard of this before. Like, well, what are you talking about? 1/3 of their money. Where does that come from? I'm like, well, I thought everybody knew this. And certainly I thought people who worked in the industry knew this, but apparently not. So let's go through this really quickly. So this is just a compound interest calculator. It's very basic stuff. We're going to start with $10,000. Now, we do need an annual return to put in. This was one of my issues with what this original person said, because what they essentially did is they showed a future value calculator. And that's not really what we're talking about, because as you'll see later on, there is actually a pretty big difference between the annual return that your advisor is able to get you. But from my article, I was actually showing that even during this very strong bull market from 2012, the reason I go back to 2012 here is because that's when VTS launched. I launched officially on January 1st, 2012. And we can see that going back, it is more or less accurate to say that diversified portfolios, whether you're talking about a 60-40, the Ray Dalio all-weather portfolio, the HFRI hedge fund index, the SIBO short volatility index, a 50-30-20, all of these things, balanced, diversified portfolios, typically will fall in the range of about 6 to 8% during a bull market. But of course, when you factor in bull markets and bear markets, the best of the best, but also the times when the market collapses, I think it's fair to say that it'll probably be in the, say, 3 to 7% range. But in my article, I said, let me be fair and use the high end, which is 7%. So I'm going to do that again. I'm going to go 7% here. We're going to assume capital gains. All of this is happening in a tax sheltered account. So taxes will be paid at some point along the way, but we're not even going to factor that in. Monthly addition, we're just going to say $1,000. Let's just keep it simple. Hopefully people can save at least that much, maybe a little bit more if possible, but that's just a number we're going to go with. And then wage growth, we're also going to say 4%. Now, statistically speaking, it's not quite that high, but again, I'm trying to be as generous as I possibly can with these numbers. And you'll see that again when I go for the inflation number. I'm going to say 3%, but we're going to circle back to this inflation number because obviously that is a major component here. But with those input variables, you can see here, starting with 10,000, making 7% a year, adding 1,000 a month plus the wage growth. So it's not always 1,000, it grows over time. No taxes, of course, real wage growth 1% over inflation, compounding for 30 years with no advisor fee. This person actually will have $1.17 million. So you think, great, they'll have over $1 million. This is awesome. But the one thing we have to factor in, of course, is that $695,000 of that money was just the money they added. That has nothing to do with the investment return. That is just $1,000 a month increased with wage growth over 30 years. It's $695,000. So the profit from investing is $476,000. Still not bad, but you can see the majority of this was just money they deposited. And then what we can do, I've set this up to have a comparison here. Instead of 7%, we're going to do 6 because we're going to assume that the person is paying 1% a year in fees. Their money grows 7, they kick back 1, down to 6. Again, tax sheltered, monthly addition exactly the same, wage growth 4 the same, inflation 3 the same. Well, this person here, all of the same inputs, except this person is paying 1% a year. This person still has a little over $1 million. So again, it doesn't sound that bad. It sounds like it's actually quite similar. But again, $695,000 of that was the money they added themselves only $323,000 is from investing activity. And this is where we get to the punchline. Because the difference between these two, no advisor and having an advisor paying 1% a year, is actually $153,000. Now, again, people might be looking at it like, okay, but they're both millionaires. What is 153? It's not that bad. Well, actually, 153 compared to 476,000 from the direct investing, that is actually 32%. So instead of making 476, you make 323. That advisor cost this investor 32% of their money. 1% a year doesn't sound like much, but when you factor it over compounding 30 years, it's costing you about 1/3 of the money you potentially would have made. So again, getting back to that Twitter thing, this is exactly what I meant. Forget about the formula the person was using. That was incorrect. But if you use a compound calculator, you can see that it is about 1/3 of the money. And again, I don't feel like I'm spoiling anything here. I actually thought that every single financial advisor in the world at some point would have encountered these numbers. I'm sure there's thousands, tens of thousands of people that have done this same analysis. I'm not doing anything special here. I don't think it would take me very long to Google. I'd probably find 100 books with the same conclusion. This is obvious. This is simple math. And it's also, once you see it, it is actually a little bit intuitive, right? I mean, if you're making 7% a year, right? Long-term, bull markets, bear markets, I think for a diversified portfolio, that's being generous. Probably because stocks are at all-time highs and the bond market is basically, the 35-year bull market is mathematically over. I mean, rates can't drop from 20% to zero anymore. That's not going to happen. So I don't think it's unrealistic to say that 7% is being generous. But when you've got 7 and then you deduct inflation, you're really only talking about investors making about 3% over the inflation rate. Take 1% out of that because of fees, starts to become rather obvious, right? I mean, grade 7 math at this point can handle this. So I don't feel like I'm doing anything special here, but apparently I struck a nerve with some people and, that's where we're at. So that is where the 1/3 number comes from. But like I said, I do also want to have something constructive come out of this. I'm not just doing this to prove a little point. So what I will say is this is grim. And this is why studies do show that roughly 90% or more of financial advisors are actually not benefiting the clients that they are serving. It is simply because people are paying way too much money for it. I'll circle back to what the 10% should be doing. But this doesn't mean that you just across the board should never hire a financial advisor. So this is where I'm going to throw out the olive branch a little bit. There are some situations where a financial advisor would actually still be valuable. The first one would be that if that financial advisor had a track record where they were outperforming the market. Because what we can look at here, like I said, the rate of return is going to matter. So down here, I basically compiled everything exactly the same, like we were talking about, the 30 years. And there's that 32%. But you can imagine if the advisor, instead of making 7%, let's say they could make 12 for their client. That would mean that this person is making 11. That 1% is a smaller percentage of the overall gain that they're making, right? So, intuitively, you're talking about a more valuable financial advisor, and we can see that in the numbers. Now the cost over 30 years is about 21%. Still significant, but it's now 1/5 instead of 1/3. So if your financial advisor was a really good one from the investment return perspective, again, this is why the original guy got it wrong doing the future value calculation that does not reflect changing rates of return. If your advisor is really good, he can actually improve that ratio. Now, it does drop off pretty quickly. Some people might be wondering, well, okay, what if he makes 20? That means that this person makes 19. It's not going to go down quite as low as people think, right? It kind of plateaus there because, of course, as you do better, the more money you make, it's still 1% of your assets. And the higher your asset base grows, he still gets that 1%. It doesn't scale any lower. It's always 1%. So you can't really avoid sort of the 1/5 range, but you certainly can avoid that 30% range, that 1/3 range. And let's be honest, most financial advisors don't even make 7% for their clients. So it's probably closer to 40%. But like I said, if they have a track record of success and there is some reason for you to believe that this specific advisor that you have is exceptionally good at investing and they can actually bump up your return, then perhaps you could justify it. The second thing is that you lack discipline in your investing. Now, the truth is, most financial advisors, when you sign up, they will basically put your money in some type of pie chart, bunch of different asset classes. It's not obviously going to look like this. This is just something I pulled off the internet, but familiar, right? People have seen this before. This is basically what the business is. They are marketers, and on the front end, they bring the clients in, and then they send your asset base to the people in the back, and those people are the ones that allocate your portfolio to the pie chart that matches whatever you signed up for in your Know Your Client thing. So this itself is not rocket science, but the truth is, even something that basic can actually be difficult sometimes for clients to follow, right? Financial crisis happens. The news media is telling you the sky is falling. Everything's terrible. Oh my God, this is the one. This is the big one. It's never coming back. It's going to feel like the end of the world. It's not, right? The markets keep going forward, but it's going to feel that way. And for a lot of people, they can't handle that. And in the moment, they will make bad decisions. So if you are the type of person that doesn't have a whole lot of discipline, and you are the type of person that you might actually make some bad emotional decisions, then sometimes having somebody basically act as a custodian for your money so that you're not in charge of making those bad decisions, maybe that would be a reason. Now, if you're going to pay 1/3 of your capital for that, that's a lot, but I'm just saying that that could be one of the reasons. And then the third thing would be, let's say you do actually have a very complicated and, importantly, dynamic and ever-changing investing situation. This is another one of those things where, for the vast majority of people, if you're just, husband and wife working semi-normal jobs and you've got a couple of kids and everything's kind of stable, there's no reason for a financial planner that's really intimate with all of your information. But if you are the type of person, let's say you run a really complex business, or, you've got multiple businesses and you've got different accounts and you're income sharing with your wife and you're trying to protect your taxes over here and you're trying to wealth plan here and pass this off to your kids and they've got child, education funds going. If you are in a situation where you feel like it's extremely complex, well, okay, then maybe at that point you might fall into the category of, I just need to pay somebody 1% a year, basically on retainer, to manage this very difficult situation. I think that for most people, no, that probably doesn't apply. But there are some people that it is best to just have an expert there constantly growing with you over time. So that's what I would say, that financial advisors, for the most part, are way too expensive and they provide way too little value. But if a person fell into these categories, I could maybe see a point to it. Now, again, paying an approximate 1/3 of your asset base, that is a steep, steep price. So hopefully you know what you're paying for. Now, what I would actually recommend people do is they should divide their financial life into two different experts. Because in my opinion, these are basically two entirely different jobs. This is another way that clients kind of get sidetracked, that financial advisors, for the most part, are marketing experts, right? They're not people who have 20 years of investing experience with compiled track records and they understand volatility and options trading. It's typically not that. They're basically just marketing experts who get the clients in and then invest in basically well-known, low-hanging fruit systems like pie charts, like I said. But you actually want to divide it into two ways, because you don't want to have that person sitting across the desk from you saying, well, no, you don't understand. The investing is only some of it, but we do tax planning and we do estate planning and we help you with your child education funds and all. They try to pile all these things in, and then it starts to sound like, okay, well, maybe this is worth it. So what I would suggest people do is just understand that these are two entirely different skill sets. So the first skill set is you want your investing guy. This is the person that focuses on only one thing: maximizing your risk-adjusted rate of return. Notice I said risk-adjusted. I'm not talking about maximizing your rate of return in bull markets. I'm talking about your risk-adjusted return, meaning a long-term 30-year track record that you are accepting. 12% would be great. As I always say, 15% a year forever is my goal. But your investing guy has that skill set and hopefully has the history to show that they actually know how to make money and beat the market. And then the second person is your financial planner. This is the person that helps you with the tax efficiency, account structure, estate planning, income sharing with your wife. All the things that fall under the umbrella of financial planner, These are two different skill sets. Be very careful trying to merge them into one to try to think, well, I'm just paying 1% for all of it. No, you're paying 1/3 of your asset base for not a whole lot of return on the other side. So a little bit of self-serving nature here, but again, dividing your financial life into two different experts. For example, I would be the investment guy. I'm not a tax expert. You don't sign up for my community to learn about estate planning. I don't ever mention that thing. We have members from over 70 countries around the world. It would be insane for me to actually represent myself as a tax expert. I am not. I'm a trader. I focus on crushing the market. That's what I do. So of course, there is a free trial for everybody available. If you want, you just go to my website here, go to the subscribe tab. Everybody who signs up gets a free 2-week trial. Give it a shot. You never know, right? You have to actually see it, first of all, to know what you're getting into. And it's a free 2-week trial. You're going to see all the live trades. You're going to see the portfolio, all of that stuff. Like I said, for me, 15% a year forever is kind of the goal. We've done significantly better than that so far. But again, to be fair, it has been a bull market. Now, I do specialize in protecting capital during bear markets, but we haven't really had the opportunity to prove that much yet. So it has been a fairly long, stable, aside from COVID, bull market. But I also want to point out just real quickly here, if my fee is $849 a year, which it is, that is a flat rate. So if you do have $100,000 in capital, that is a 0.85% a year fee. A little bit lower than the 1%, but it's kind of the same. But you'll notice that when you're paying a flat rate, as your asset base grows, which hopefully it is if you're making 15% a year, and you're saving and living below your means and you're adding money to your account, the larger your asset base, the lower that fee gets. So at $500,000, it's a 0.17% per year fee. Once you get to $1 million, you're talking about S&P 500 index fund level of fees. It's basically free. Like I said, it's been mostly a bull market. I do specialize in what we're going to do to capitalize on the next financial crisis, but flat rate wins every single time. And the second person, that's when you're going to go out and you're going to find yourself a competent financial planner. This person is not going to talk about investing with you. They're not going to talk about your rate of return and how to beat the market. They don't know how to do that. What these people know how to do, this team or this person that you're going to hire, this is your tax person. This is your wealth planner. This is the person that understands what you and your wife do for a living, and maybe there's opportunities to share income. Maybe there's tax advantages. Maybe you can work your kids in a little bit. That's their job. And what I would suggest, don't ever pay a percentage of assets. That is insane. It's going to cost you about 1/3 of your money. What you should be doing is paying a flat rate advisor. Similar to what I was saying about me, don't ever pay somebody who's investing your money that the more money you have, the more money you pay them. You want it to actually go the other way. You want things to get cheaper as you go. So what I would advise people do is they basically hire a flat rate advisor to do 3 sets of 2-hour sessions. Now, of course, there's wiggle room. It can be 4 sets of 3 or 1 hour, whatever you need. But the point is, flat rate advisor is going to cost you a little bit of money up front. But financial planning is not something that you need somebody on retainer constantly. You don't need to give up 1/3 of your money. You could do something this basic. Session 1, it's just going to be a conversation, him getting to know your entire financial situation. That's not going to take very long. Like I said, if you have a super complex structure, got multiple businesses and it's all crazy and it's moving targets, okay, fine, find a team and do that. But for most people, it's very, very simple. Session 2 would be about actually doing the plan, moving capital, signing papers, getting everything worked out. This doesn't take very long, but you want to separate it by a few weeks, maybe a month, just so that there's time to do all this, right? The signing of the papers is easy, but you have to allow some time for those transactions to take place. And then the last session, you basically just want to confirm everything, have everything explained to you, where all the money is, what all the accounts are for. And from there, you're kind of set. At that point, your investing guy jumps in and does his job. This financial planner guy, this job is over. Not forever. Like I said here, every few years, you can go back for an hour or two and you can just check the progress of everything. But again, you don't need to pay a retainer and just have that constant bleed of capital going to a person who at the end of the day, this is like 5 hours of work a year. But if you want to make money in the market, you have to be doing something different than the market, which actually requires an investing person that knows what they're doing and they actually have decades of experience. Not financial planning, actual investing. Totally different skill sets. So that's basically where we're at. As far as the argument that I was having online, There is no argument. This is extremely basic math. I mean, if you really want to dumb it down to 7% return minus 4% inflation, that's 3%. Hopefully people know that. And then if you're paying 1% of that in assets, yeah, it's really not difficult to figure out. Speaking of which, the inflation thing, I said I'd circle back to that. It is actually quite important because, of course, let's put this back to 6% for that person and 7% for this person. You see, I've been using 3% inflation. But hopefully people know at this point, if we go to a website called shadowstats.com, they're not plucking numbers out of thin air here. What they're essentially doing is they're using the 1990 formula for calculating the CPI, and they're dragging that forward. This is one of the reasons why inflation, we always say in the real world, it's much higher than the government is representing. It's because this is what they've been doing. And it's not just a Trump thing. It's, all the presidents for the last 20, 30 years have done this. They are consistently changing the formula. They're overweighting certain things, they're underweighting others, and it makes it look like the CPI is actually pretty reasonable. If you just use the old formula, I mean, maybe this isn't exactly accurate, but 4% inflation turns into 7 or 8. And I think this is the experience for most people in the real world, right? You're tracking your budget, you're living your life, and you realize, wow, this is really, really expensive, and my wages are not actually keeping up. Well, this is why. It's because the real inflation rate isn't 3%. What if it's closer to 6? Watch what this does to the numbers if we just up that up to 6. Well, now we have a huge problem, don't we? Well, I mean, look at how much money it's costing. You're actually paying your financial advisor more money than he's making you. Because, of course, there is no rate of return now. You're still paying the $695,000. That's the money that you added along the way. But you're basically paying more than your share of the compounded inflation along the way. This is a serious problem. So this is why I'm not the only one that's ever done this. There's many, many people that have gone through this analysis, but this is why you hear so many times where people say financial advisors are not worth it. It's true. In reality, probably, plucked out of thin air, 90% of financial advisors are costing their clients more money than they're adding value. Doesn't mean that you're losing money, but when you pay an advisor, you're actually expecting more than to give 1/3 of your assets to somebody else for not doing a whole lot. So like I said, there are things that you can do, but there are also ways to look at it that maybe for a certain person, it would be valuable. And this would be my advice to people like that Daniel guy that were very, very argumentative and personally insulting to me for just reporting the actual math. This is not rocket science, as I said, but he was very, very angry. What I would suggest, instead of denying the basic math like that Daniel is doing, what I would suggest, here's an idea. Why don't you embrace it? If you're a financial advisor and you see online that there's a debate going on where people are saying, actually, if you calculate it long term, financial advisors cost their clients about 1/3 of their capital. Instead of you chiming in and saying, you're an idiot, you don't know anything, your math sucks, there's no studies to prove that. Instead of that, why don't you try saying, you're right. 90% of the people in my industry are not worth the money. But then you're going to spend your time differentiating yourself and trying to show people why you are in the 10%. For me personally, in my humble opinion, that is far better than trying to just deny the basic math, because you can't argue with this. This is the reality. But what you can do is try to differentiate yourself. And again, I'm not doing this to be adversarial. That person, before I did this live stream, I have invited him to do a one-on-one conversation live on camera multiple times. I invited him to come onto my YouTube channel. Still, open invitation. You want to do it next week? Let's set it up. No problem. But what he tried to do instead was deny the numbers. And my recommendation is there's probably a reason why you're not getting traction in your industry, right? This is a guy who's tweeted, 10,000 times. He's got very little followers. He's got something like almost 200 YouTube videos uploaded. He's got less than 100 subscribers. Probably it's nothing to do with you being bad. It's just you're not different. There's millions and millions of financial advisors, and you're going to be the guy denying the basic math? Not a good play, my friend. What you should be doing is saying, yes, 90% of my, coworkers essentially are losing money for their clients. But here's what I can do for you instead. Focus on that. Then you've really got something. Then you would differentiate yourself. trying to deny the simple truth. I mean, this is just a very poor strategy. And that's probably why the traction isn't really happening on your end. So I'm not trying to be rude. I'm just offering my humble advice to you that this is the reality of the investing world. And again, I thought it was common knowledge, but apparently I was wrong. There's a lot of financial advisors who don't actually know a large swath of their fellow financial advisors are giving them a very bad name. So, like I said, there are ways that you can handle it. You can divide it into two people. Your investing guy crushes the market. Your financial planner is an expert in taxes in your jurisdiction. That guy's not me. Don't come to me for tax advice. Don't ask me about wealth planning. Don't ask me how to, I live in Dubai. I don't pay taxes, but don't ask me how to dodge taxes. I can't help you. I've got clients from over 70 countries. They're all different. Go find a financial planner in your country and handle that yourself on a fee basis only. It's basically 5 hours a year could get that banged out. It's really not that complicated. Then go find yourself an investing person. So that's my job. Like I said, there's a free trial, but we've been going for quite a while here. I'm actually just going to go ahead and punt on the chart blitz, and we're just going to get right into the Q&A. So let's just have a quick word from our sponsor, and then we will do that. So we'll get to the live Q&A in just a second here, but I launched VTS all the way back in January 2012 with two main goals. First, to crush the financial industry and help investors start making real progress towards their retirement goals. And secondly, to provide that outperformance at a much lower cost. A low monthly subscription fee scales far better than paying a traditional percentage of assets. Our portfolio is currently 3 independent strategies with low correlation to the stock market and to each other. It's also not active day trading, and trust me, anybody from any background can follow VTS in just a few minutes a day. Since retiring from pro golf in 2005, I've been an options and volatility trader for over 20 years now, and I share a lot of invaluable volatility data in every daily email to subscribers. I'm also a certified workaholic, and there's a growing list of courses that all members have full access to. There's a free trial to VTS on my website available to everybody. Come join members from over 70 countries around the world. I can definitely help you achieve your financial goals. Now let's get into the live Q&A. Hello. Oh wow, that was crazy. Sorry about that. No, I was saying some fantastic stuff there. Just take my word for it. No, just kidding. Apologies there. What I was saying is I didn't mean to insult anybody, but of course, like I said, you can forward that to people, and it's sort of a double purpose here. You can say that on the one hand, it might get you some engagement, just, talk about something that's kind of a hot button subject, but also just watching how people respond to things like that. Because of course, people are very protective of their own industries. But at the same time, you don't want to be in a situation where people are denying basic realities. That is a very, very negative thing. And I'll even personalize this to me. So for me, I do have all the fancy letters behind my name. I've got multiple degrees from a very good school. I studied economics and a math degree. I could do all that, but I don't mention any of that stuff. I'm also fully certified in Canada. I've got all the RIA certifications, plus all the options and derivatives. I'm good to go, but I don't talk about that stuff. I chose to live globally, and I live in many different countries, and I travel the world. So I have to do the subscription. Is it still muted? Okay, I'm going to stop talking until somebody confirms that they can actually hear me. Somebody in the chat just shout out that I fixed it. This is blue. That's a good sign. I can see my dials moving. That's a good sign. It absolutely should be working right now. So I don't want to have to stop this live stream because of a technical error here. I just have to keep going and just assume that people are actually listening and can actually hear me. So what was I saying? I kind of lost my train of thought. Basically, what I was trying to get at is I am in an industry by choice, the subscription service model, right? Okay, fixed. Cool. Thank you for that. I am a subscription service guy. So of course, there's going to be a lot of negative connotations to what I do. Now, of course, I do think that I've been doing this for 20 years. I have a great track record and pretty much no haters. I'm a little bit different, but I'm in an industry where it would be totally rational for people to hate me simply because of what I do. And if you started throwing hate my way and saying, oh, don't listen to this clown, he's just a subscription guy, I wouldn't get offended at all. I wouldn't be in the situation with a knee-jerk reaction to try to defend myself. What I would do is say, you're absolutely right, my friend. I am working in an industry where 90% of these clowns are absolute frauds. You are correct, but here's why I'm different. And then go on that path, make videos explaining my strategies, show my results, posted them on the website every month since 2012. Start doing things that differentiate yourself. It would be asinine of me to just sit here and say, oh, no, you're crazy. My industry's awesome. We're top notch. Everybody's cool. No, we're not. There's very, very big problems in the financial industry. And when people say that, it's a real litmus test to how you personally are in your industry. If you say to a financial advisor, how come such a high percentage of you are charging so much money and giving so little value? The direction the person responds to that question can tell you an awful lot about the quality of their work. So it's the same thing with me. If you insult me and you say that I should not be listened to because I sell a subscription service, hey, that comes with the territory. It's my job to convince you why I'm in the 10%, not the 90% of losers. So that's what I would say, is that go ahead and forward this to a few financial advisors and see how they respond to it. It might actually be pretty interesting. So anyway, let's get into some of these questions. I did skip the chart blitz, so we'll come back with that next week, and I'll add a few more and maybe just do that one section. So anyway, here we go. All right. I was reading some of your old posts, and I see that you used the SSO instead of SPY. He's talking about our strategic tail risk strategy. Why the change? And have you backtested what kinds of returns drawdowns with 1/3 SVXY QLD SSO as your strategy? So great question. Let me get into this here, just to point to what he's talking about. So one of our strategies, we are of course doing 1/3, 1/3, 1/3 right now, 3 tactical rotation strategies. The one he's talking about is this one, and our stable position is SPY, the S&P 500. Now, it is true, several years ago, it has actually been quite a while, but we used to use the 2 times S&P 500, the SSO. And he's basically asking, what would the result be? Now, the reason that I don't do that anymore is there's a couple of reasons. First of all, as you can see in our defensive rotation, we use the QLD already. This is the 2 times leveraged Nasdaq. So that's a pretty aggressive position. And this strategy is, in the last 5 or 6 years, our top performer. Largely because we're using double leverage, but also the Nasdaq has done extremely well. And so we participate in all of that. And then, of course, we rotate to safety, so we don't give back all of our gains, right? This is the whole point of why buy and hold investing sucks so bad. Anybody can do well in a bull market, but you actually have to protect your capital and you have to move to safety. So that's what we do. SVXY in our tactical volatility strategy, this is not a leveraged position. And in fact, the SVXY is a minus 0.5 times leverage product. So this is actually, you could make a case, it is watered down. However, the beta, sorry, I'm throwing a lot of terms out here, but the beta, this is a measure of how much one security moves in relation to another security. The SVXY actually has a beta to the S&P 500 of 1.63. So it moves more than the S&P 500. It's actually a leveraged position in of itself. So we've got 2 leveraged positions already in the portfolio. I used to do SSO and do all 3. The reason we can kind of get away with that during stable markets is because, like I said, we do move to safety. In all three of the strategies, we use gold here, we use long vol. In this one, we use utilities and then cash. And in this one, we use the IYR. And a new addition this year is the Chaos ETF. We also used to use long volatility there. But I have just made a decision that having leverage in all three strategies is overkill at this point, especially since we could make a case, and my crystal ball is just as broken as anybody else's. I don't trade based on gut instincts or personal predictions. It's all the math, it's all the numbers, analyzing volatility data, and that directs all of my trade signals. But just intuitively, it's been a roughly 14, 15-year bull market minus a couple of scary little short-term crashes. So now might not be the best time to be triple leveraged in all three of our strategies. It is certainly possible that, say, for example, and I'm not saying we're going to do this, but let's just say there was a financial crisis. It's going to take a few years to work through that, and we would be in mostly safety positions, and then maybe some long volatility, and we'll make some money, hopefully, if the market really crashes. Like a repeat of 2008, I'm not going to be happy if it happens because it's going to hurt a lot of people, but I would suspect that we would do pretty well in that situation. But coming out of it on the other side, at that point, you could potentially do SSO here. You could do the 2 times leveraged on the other side of a market crash. I would not go more than 2 times here. But even here, you could use the SVIX, which is the -1. It's basically double the leverage factor of this one. You could, I'm probably not going to do that. I'm much more of a conservative investor that likes to move to safety and protect capital. But I'm not going to tell you can't do that. I'm just saying that right now, we're already in 2 of our 3 strategies leveraged. It doesn't make much sense to do the third one in 2025. If it was 2017, like the question you're asking, sure. Yeah, absolutely. Not now. All right. Thoughts on how long QLD can sink through market rotation while volatility stays low? This is a timely question. We're seeing that this week, meaning we are invested. I just bought in recently, so did not enjoy the prior gains. Sorry to hear that. I mean, everybody joins at a different time. The one thing I will say about that last point is that, yeah, I don't mean to sound cold. This is money we're talking about. But whatever you do in the short term, like you joined VTS and you didn't experience all the prior success of that strategy. I mean, it's been crushing it for years. Whatever you do, like in the short term, is just a blip on the long-term chart. You need to focus on 20 years. So whatever you did or didn't participate in, hopefully you've got a timeline that is just going to make it a moot point. But the truth is, what you're explaining, it can happen. And that's why in all 3 of our strategies, even when we're aggressive, these are 3 different aggressive positions, and they move in 3 different ways. They are correlated. There's no doubt that short volatility is a quasi-long equities position. Or you could say that the other way around. Whenever you're buying the stock market, you are essentially short volatility. This is true. But they're low enough correlation that there is benefit to using 3 different ones in an aggressive market cycle. And there are times when the Nasdaq, for example, will do extremely well, but short volatility won't. We'll give you an example of that. So if we look at QQQ, let's just do the 1 times just so we can see it on a chart. I believe this is a 2-year chart, I hope. So this is a 2-year chart. You can see the Nasdaq, aside from the tariff nonsense earlier in the year, it's, basically at all-time highs, give or take. It's doing fine. Look at the SVXY. Not the same chart at all. There are times when the stock market does extremely well and short volatility will not. And there are times when the opposite is true. On the very, very short term, we are seeing one of those right now where, I mean, today for sure, it's obvious that the Nasdaq's getting crushed, right? There are some individual stocks that are just down a ton in the last day or two. And that can decouple from short volatility. And then it can also go the other way. There are times like 2015, tail end of that, China hard landing scare coming out in March 2016, all the way to Volpocalypse. The short vol trade was miles ahead of equities. Even though they're correlated, they are kind of different positions. And recently in the last week, we've seen the market kind of flat-ish, volatility get crushed. Our SVXY position has done way better than our Nasdaq position. So this is a long roundabout way of saying that this is what happens when you've got three correlated but different underlying assets working together in the same portfolio. It wouldn't make any sense for me to just use one, because using all three of them adds diversification. They are different enough, similar, but they are different enough that it adds value. Unfortunately, what you are experiencing, QLD has not had a good week, whereas SVXY, I would say all in all, has had a very good week. It happens. It does happen, but long term is what we are focusing on. And we use the S&P, double Nasdaq, and short volatility during stable markets. Can't guarantee they all do well at the same time. Hopefully, the last couple of years, short vol has not had a good run. And thankfully, we've had the SPY and the Nasdaq to cover up for that. Okay. First of all, hello, welcome. Maybe we should do coffee. I am back in town. Wifey says hello. She jokes around. I wasn't being disrespectful, and she didn't take it this way, but we were kind of joking around because last live stream I did, I always tell people my live streams are free. I don't sell stuff. I don't want you to super chat. Don't send me any money. That's not what this is about. This is just free Q&A sessions. But a super chat came up, and it was my wife, and I was like, what is going on? What is that? Right? And it kind of threw me off. And then I made this offhand comment that, it's only, 20 NT dollars or something, which is the equivalent of, I think I said a quarter of a cup of coffee. And I think that it came off like differently than I meant it. So some of the people in the chat were like, damn, that was a little bit strong. No, I didn't mean anything by it, but hello, glad you're watching. You can turn it off now. I know I'm just the most boring person in the world. All right, let's get to this question. If I wanted to backtest some other ETF rather than the IYR that you used, do you have a way to do that kind of backtest? Yes, I do. I know you want to protect your secret sauce. Is there some middle ground of implying you already know I don't like to share past data? I would love if I was in a situation where I could just give out all the past data, strategy signals, volatility barometer levels, the numbers themselves. I would love it if I could just include that in the free volatility download. There's a spreadsheet that's out there with all the VIX futures, all the volatility ETPs going back to inception, simulated back to 2004. A bunch of other calculators and whatnot. You can download that. Just go to my website and search, just type in Excel in the search button and it'll come up. But I don't include the specific past data for our strategies or the volatility barometer. The reason is basically I do have a lot of copycat people who try to sell my service to other people. And I have no defense against this. This is just one of those, it's just part of the territory. I manage a subscription. And with just an email, people can sign up. I don't know who's signing up. I don't know if this is a hedge fund who's, parroting my signals to his community and his clients and passing it off as his own. I don't know if somebody's, built up a newsletter list and they're taking my signals and transferring it to other people. The only real defense I have against this, and it's a pretty weak one, but it's all I've got, is I just don't share data of the past strategies or the volatility barometer. So if one of their clients that's taking money from him, I would say illegally. I mean, if they're a registered advisor, that is obviously, not good. Your clients have to know that that's happening. But maybe they won't have an intelligent answer to give that person. Somebody will say, well, hey, what were the barometer levels in 2018? Or, your performance looks like it has a little bit of a blip in 2017. What were the numbers? Maybe they won't have any intelligent answer and it'll be obvious that they're stealing signals or something. It's all I've got. So that, again, long roundabout way of saying there are certain parts of the data stream in my workload that I just can't share. I just have to keep it proprietary. Past trade signals seems like an obvious one. I don't want people being able to answer those questions intelligently and kind of fill in the blanks and pretend that it's their work when it's really not. I literally have a fund in Europe that's using my exact, it's whatever. It's maybe there's an avenue that I can take to shut that down, but it's all I've got. So let me tell you, there is really only one way we can do this. You can email me. a list of ETFs that you would like to see replaced for the IYR, and I will make it a topic in a future live stream. It's kind of the best I can do, because of course it sounds like I'm being a dick when I say I can't give you the information because people are using my signals to make money on the side. It sounds like I'm accusing you of trying to steal. I'm not. I understand that 99.9% of people have no intention other than just keeping it on their own computer, running a few numbers by themselves. They would never share it. They would never post it online. But it's one of those things where you remember back in school, that one dumbass kid puts gum under his table, and then now the whole class can't chew gum in class. It's one of those things that a few bad people have ruined it for everybody. So I can't, unfortunately, it's just a policy of mine. I don't share those numbers, but I will run it for you, and I'll just go through all the charts in a live stream. That might, I know it's not as good. You'd like it to just have it yourself, but it's the best I can do, unfortunately. But that might be a fun live stream. So go ahead and send me that, and we will we'll check out some comparisons. Okay, just one correction. Okay, it is 30% of the profit, not of the capital, which is the entire portfolio. That is true. Is that not what I said? Sometimes when you're on lives, you just kind of talk, and I'm kind of a nervous person anyway, so maybe I misworded. Yes, of course it is. Because, like I said, the $695,000 is just what the person deposited. That money would be in the account whether you had an advisor, didn't have an advisor, had Jim Simons investing your money, or had the worst trader on the planet investing your money. We don't count that. That's your own deposit. I'm only measuring what is the alpha that this advisor is getting versus not having an advisor. So yes, the 33%, the roughly 1/3 basically monetary hit that you take when you have a run-of-the-mill financial advisor is, if it wasn't clear in the way that I worded it, it is on the potential investing related profit, not the total value, because that person that's adding $1,000 a month growing with wage growth, they're going to get to 700 grand no matter what they do. They deposited that money themselves. We don't count that. We're just talking about 153 grand versus 470 or whatever it was. That's a huge amount of money that financial advisor is charging. 1% a year doesn't sound like much, but 1/3 of the potential investing profit sounds like an awful lot. So now here we go with all the audio stuff. It wouldn't be one of my live streams if we didn't have the occasional technical difficulty. It happens. Do you have any pure systematic option strategies? That's a good question. That's a really good question. Just running the list in my head. To be honest, no. A few of them that you may have heard me mention from time to time. Well, first of all, we'll start with iron condors, because they have in the past been in and out of the portfolio. Iron condors there's discretion involved in when to open them. But as far as the rule set, it's very structured, right? So what you can do is, let me pull up the old YouTube channel. It's always good to, I don't plug my work or anything. I want people to feel like the live streams are totally free and that it's not an advertisement for my work. But anytime I can pull up the old YouTube and actually point to something, forgive me, but I'm obviously going to do that. So this one called 10 Rules to, what is it? Clickbait YouTube title, Master the 10 Iron Condor Rules for Max Profit in Caps. That's a pretty good title. This video has 77,000 views. Compared to some of my other videos, this one's pretty good at 9. Some of them get like 1,000 views, and this one got 77,000. But in this video, I went through 10 rules, and those rules are pretty structured. I mean, it's literally like 45 to 75 days to expiration. It's 3% of capital. It's, open it with this. And if it gets inside 30 days and it hasn't hit the stop losses of 50%, then you close it. You can use the template and it's basically plug and play, but there is the discretionary element of when do you enter the trade, right? I don't like to do just hard rules, because I've talked about this many times, but if you just sell options there's this wild misconception in the world of option trading where if you're just the option seller, you're on the right side of the trade and the option buyers are on the wrong side of the trade. And all you got to do is just sell premium and just like do this and you make money. This is absolutely not true. The options market is actually priced quite efficiently. And you really, longs, it's true that on a percentage win rate, that is much lower, but then you can get a very convex win rate. When you do get a winner, it can be a huge winner. So it's basically a wash, right? If you sell premium on a calendar schedule, like a structured, I'm going to sell an iron condor for 45 days out every 30 days cycle, right? Every time that option gets refreshed and it's 30, I'm going to do that. If you do that, your expected rate of return is basically zero minus trade fees. There's no edge in structured, I'm going to sell weekly options every Friday and I'm going to close them out the following Friday. 0% minus trade fees. There's no edge there at all. So you have to build up some edges. And one of the edges is knowing how to enter and what the best structure for an entry for an iron condor is versus, say, a long straddle, which is long options. These are totally different things. So there is no, in my personal opinion, the way that I trade options, there is no purely systematic way to do it. There is always going to be a discretionary element, but I like to have a discretionary element for certain things and then a very structured method for some of the big things like position sizing, like, time frames, stop losses and things like that. So I would say iron condors, kind of yes, but no, there's discretion. VIX options is a very structured format that I've just been doing rinse and repeat every single month since 2011. It's very structured, but there's some discretion. The Wheel of Fun, of course, entries are discretionary, but then there's structure. It's kind of the same story across the board. My earnings plays, structure with discretionary entries. I think maybe that's the underlying theme. That's a good question. I like that. But yeah, that would be my answer is that, let's say 20% discretionary, 80% systematic. Whereas my tactical rotation is 100% systematic. And the only discretion involved is occasionally I'll run an audit on what's going on and maybe make a few changes. Like if I replace IYR for something else, that is technically not 100% systematic. But when the strategy is going, I just wake up in the morning. I don't know what the strategy is going to trade that day either. I just input all the data and it spits out the trade. And I'm like, oh, wow, look at that. We're long equities. All right. Okay. It seems that over the past 6 months, TVS, Tactical Volatility Strategy, underperformed buy and hold SVXY with almost exact drawdowns. I haven't run the numbers, but I would not be surprised if that was the case. Is there any way to make the TVS more responsive to changes in vol? So this is a really good question. Unfortunately, the answer is that time is the element that you're missing. Of course, first of all, I'm not sure if that's true. Let me just eyeball here what SVXY. No, that's absolutely not true. SVXY is flat for the year. So, but you did say 6 months. So I think what you're talking about is we re-entered maybe somewhere around here, and we've largely been long SVXY the entire time. We had to exit once here, which we would have bled a little bit of capital. We exited here and probably, yes, certainly here. For like 5 or 6 days we exited. And anytime you exit and then the market bounces back, of course you've bled capital when that happens. The plan is that if it drops down and you exit to safety and then the market actually, flushes down, that's when you make the real alpha, right? It's always far easier to improve your rate of return by reducing your drawdowns rather than trying to chase performance in good periods. But that's a bleed because the market bounced very quickly. This is a bleed. But eventually it's going to pay off, obviously. But I would say in the whole year, it's not the case. But your question is not, it's a valid question. What I would say is it is actually fairly difficult, unless it's your stated goal. It's actually fairly difficult to beat the market when the market's doing really well. because like I said, even the slightest deviation away from buy and hold, and you're obviously going to be underperforming buy and hold. So if you're looking at a 6-month window where you saw on the chart, SVXY has gone from here to here, and it's basically just done really, really well, that's not a period where tactical volatility trading is going to beat buy and hold. It's just not, unfortunately. But during the tariff stuff, I mean, we saved a ton during that. And so we built up a huge lead, and now it's outperforming. And then you drag that back to 2012, that tactical strategy has been in the portfolio since January 2012, minus about a year. It is so far ahead of buy and hold, it's just not even worth talking about, right? But on a shorter time frame, and of course, I'm quite sure you joined around that time, right? You haven't been a member for that long. It must feel like, hey, what he underperformed. Why didn't I just buy and hold the SVXY? Well, you don't do that because it had a 95% drawdown. That's why you don't do that. We didn't, right? In COVID, we lost 0% loss. SVXY was an absolute bloodbath. So that's where you build up your capital. Unfortunately, it's actually fairly difficult to beat the market when it's rocketing higher. That's not what I focus on because that's not what's important. Like I said, you can try to be that guy. If it's your stated goal to beat the market when the market's doing well, leverage is the key. If the stock market rages higher and you add a little bit of leverage, you will outperform the market. If the market's raging higher and you're trading long call options, you're going to beat the market. But then what's going to happen to your capital when the market goes down? You're going to lose even more than the market when it goes down. So like I said, that's not my goal. My goal is to improve my rate of return over a 30-year period by avoiding as much of the damage as possible, while also, I just flashed it really quickly, briefly, but you can see that when we are fully allocated, we are at a higher beta to the S&P 500 in our portfolio. So as long as we don't exit to safety and lose a little bit on the bleed, on that little whipsaw action, we can significantly outperform the market. And we have this year, but there are times when that's not the case. And usually when it's not the case, it's like I said, if the market's going up and it's uninterrupted, absolutely the best thing to do is buy and hold. But that is a crazy bad strategy anytime there's trouble in the market. So we have to be a little bit forward thinking and say, yeah, we're not going to win every time, but surely on a long enough time horizon, people can realize that exiting to safety just out of pure self-preservation is the right way to invest, even though it doesn't always work. Okay, please give me your email. So you can just do volatility trading strategies at gmail.com or at hotmail.com. Okay, where are we at here? If we can't test something like IYR, can you please recommend 2 to 3 alternatives for those who aren't comfortable with IYR? So I will remind you, though, that perhaps you haven't seen it, but the strategic tail risk strategy doesn't always use IYR. There is actually what we call the interest rate sensitivity part of it, where, of course, IYR is an interest rate sensitive asset, and it does really well during stable interest rates or when interest rates are dropping. But anytime the Fed is signaling that is at a fairly obvious rate hike, a moment where they're quite clearly going to be hiking rates, let me just try to pull something up here. Anytime there was a period where it's just obvious that rates are going to be going up, you would not want to be holding the IYR. And that's when we cycle into Coca-Cola, just the stock, plain old vanilla Coca-Cola. It's actually a really, really good defensive position, certainly when interest rates are going up. So what you see in the strategy that shows IYR, this is only now. And I don't anticipate the Fed raising rates anytime soon. So it's going to be like this for a while. I don't think personally, and I can't tell you what to do with your money. Remember, VTS is just me telling you what I do with my money. I'm not telling you what you should do with yours. I'm just showing you what my portfolio looks like. But I don't personally think there's any reason not to be confident that IYR is a good safety position as long as interest rates are not rising. If you wanted to substitute it out, we already use utilities. That's a great safety position, but we use that in defensive rotation. Gold is an awesome safety position, but we use that in tactical volatility. IYR is the third best. It really is. There are other things that have temporary periods of radically good success, like emerging markets can work sometimes. Obviously, long volatility if it's a real crash. But IYR actually does it, like I said, it's third in line. It's a good safety position. It's just, times like 2022, not so good. But yeah, that's what I would say is give me a list, email it to me, and I'll just show you firsthand. And we'll do all the usual suspects, whatever you want to see, like consumer staples ETFs and all of, like Walmart and whatever you want to see. Just email me a list and we'll make it a whole live stream. Okay, take a look at Simplify's QIS. Couldn't lose that much if I tried. I don't know what that is, but there are a lot of garbage ETFs out there. I'll bet you the marketing's great, though. I'll bet you it has a surprising amount of assets under management, whatever this thing is. Maybe I know it and it's just not ringing a bell. Let me see what comes up here. QIS. Simplify multi-QIS strategy. Let's see. Okay, well, 65 million assets under management. It's not nothing, but that's pretty low. Okay, let's check out a chart here. Check out QIS. You couldn't do this bad if you tried. Let's see. Oh, wow. What is this thing? Is this designed to just rocket higher in a bear market or something? This thing is, I'm not even doing screen share. Oops. This thing is awful. Whatever is going on here, let's see how long this thing has been an ETF. Max available. That's it. A new launch. It's 2 years old. Yeah. I don't think you could do worse. I think you're right. I think that if you actually tried, you'd have a hard time finding assets that have done this poorly. You'd have to go really far down the list of individual stocks on the S&P, just filter, do a scan for the worst ones. Yeah, that's bad news. Now, the only thing I would say is I don't know what the fund is designed to do. Is it possible that this is just a super convex? Well, no, it's not, because even during the tariff stuff, it got killed. Went up initially and then got destroyed. This looks to me like this is a fund manager just fishing for something. Didn't know what they were doing. And that's the thing about something is like a large outfit like Simplify. It's not like their whole suite is good. They probably only have like 2 or 3 that are even worth looking at. And the rest is just pure garbage. I'm not criticizing them. It's just kind of the whole thing. These big houses that have a suite of 15 ETFs, it's like 2 of them that are good. Maybe that's just them fishing for some weird strategy that they thought was supposed to hit, and it obviously didn't. That is, yeah. Like take that challenge. Try to lose half your money in a the last 6 months where the market has rocketed higher. Be interesting to see. I wonder if long volatility is even better than that. Let's put that up against VXZ. See what happens. Look at that. VXZ is actually even a little bit better. That's crazy. Yeah. Simplify. Okay. I guess my question is, buy and hold was more about how to tweak the indicators to be more responsive to short-term rapid downturns. Let me read that again. VTS buy and hold was more about how to tweak the indicators to be more responsive to short-term rapid downturns. I would not say that's true. That we have been seeing since the Fed announced in 12/24. I would not say that's true. No. My strategies are not, I don't know, I wouldn't say they're overly complex. Let's go to the one you're talking about. It's essentially that if volatility, which I have, data mined a lot of different volatility metrics to come up with these numbers, it's not, obviously the VIX is pure garbage, but, if the volatility barometer, roughly speaking, is 65% or below, there would be no reason for an investor not to be net long equities, net short volatility. But anytime it's above that, you're going to have to find somewhere else to put your money, because this is where all the bad things happen. It doesn't mean it's going to happen. That's the thing. It's not a predictive thing where, let's get this QIS off of here. if you're looking at a situation just in the last few months where certainly here the volatility barometer dipped into that range where I'm saying you have to move to safety, and it went there here as well. You have to move to safety. Now, we've participated in this uptrend, but you've got to get out of the market at that point. But it's not 100% foolproof thing. Like every time volatility hits 80%, the terrible things happen and the market crashes. I wish investing was that easy. I'd be a billionaire, right? It's just not the case. So I would say no. The premise that it is supposed to just somehow, I don't want to use the word miraculously. That sounds a little condescending, but I think you get my point. No, I would say look at the long-term track record. I should even show that at some point in a future live stream. Like look at the tactical volatility strategy making, over 30% a year since 2012. Compare that to the SVXY since 2012. It is, what are we talking about here? But sometimes you can't see it on a 6-month chart when the SVXY is just buy and hold. There's no problem at all. Smooth sailing. Yeah. There's no advantage to tactical investing when the market's doing extremely well. It's just true. All that we can do is take a little leverage, which we do. That's the only way to beat the market when the market's doing well. Just leverage the market and you'll beat it. But we have to be smarter than that. We have to actually move to safety every single time, no matter what, because I don't know which one is the big one, but there is a big one coming. And this question, I'm not saying haha, gotcha, but this question will seem silly as soon as the market actually crashes. You'll be like, oh, yeah, okay, I see what he was saying. Okay, for the strategy that uses SPY during safe market, how about selling, not to roll my eyes here, I just get this one a lot. How about selling a call 1 month expiry, 1 to 2% above the current, and then use that as a buffer so we don't need to exit to safety? Okay. It is a good question. It is a very valid question. Essentially, why don't you sell covered calls when you're in your aggressive positions? So let's pick the SPY, like you said. When we're in the SPY and we are in an uptrend, why don't you sell covered calls? Well, the truth is, a covered call itself, and there's a reason why all of these buy right strategies and these packaged ETFs that are income selling, they're all trash, every single one of them, top to bottom, no exceptions, they're all bad. And the reason for that is when you're doing that type of systematic strategy, like I said, there's no real edge there. So you're just selling option premium into a market that is already efficient. When you sell a covered call, you're only making a tiny percentage boost on the underlying security, but you're not reducing your downside hardly at all. So what you're essentially doing is you're capping your gains. You're not really reducing your losses. This is not a good strategy to rinse repeat over time. And the second aspect is, while it's maybe not obvious on every chart, when you look at it long term and when you run the numbers, what you will notice is that the reason trend following works is the market tends to chop around about 80% of the time, not really going much of anywhere, and the gains happen in short little bursts. So the last thing in the world you want to be doing when you're a trend following trader is capping your gains when the SPY could go up 8% in a 5-week period, but you've sold a covered call 2% out of the money, you're out of luck. And that is especially true when you're doing the Nasdaq, when you're doing short volatility. This is just something that intuitively it sounds like a good idea. Hey, I'm already in the SPY. Why don't I make a couple percent on it? But you would never want to do that in trend following. If you want to have a totally separate strategy, independent of the strategic, and you just wanted to run an option strategy where every time it's stable, you wanted to kind of do your own buy right, go for it. See what happens. I would love for you to be successful doing that. I'd love to see that actually work. But unfortunately, the best and brightest on Wall Street have been trying for years and nobody can manage to do it. And it's really fairly obvious why that is the case. It's because, like I said, structured option selling has been dead since 2005. Like, it used to work. If you said this same thing in 1998, I'd be like, yeah, that's a good idea. It used to work. It really did. There was a very outsized gain on the short selling side. If you look at something like the Iron Condor Index, for example, the CNDR Index, from, if you backtest it going way back in the 90s all the way up to the mid 2000s, 2007, for example, it was doing really, really well. Since then, flat to negative. There is no edge anymore to the idea that, no, I'm the smart money. I'm the option seller. I'm going to win. The option buyers are going to lose. that is so 20 years ago. Like that's not the case anymore. So selling premium in a trend following strategy is not getting any of the benefit of risk management, but you are capping your gains at the exact time you would not want to be doing that. The market might go on a really good run next week. Why would I want to cap it? I just wouldn't do that. So, yeah, different strategy. Have both. Strategic tail risk is trend following only. When we're in the position, you just sit on your hands and hopefully this is one of those 6-week periods. It's just going to crush it for you. And then take another allocation of capital and have a separate option-based strategy to try to do what you're trying to do. There's nothing wrong with what you're saying. It just does not pair well with trend following. All right. Breathe. What time is it? I'm in a hotel here, so hopefully the walls are thick and nobody can hear me. All right, where are we at? Sorry, I highlighted one and then. How do you determine the trigger points for the strategies? Was it backtesting, logic, or something else? I would say it's an evolution over time. So if I were to go back to before I launched VTS, my history is basically that I retired from golf in 2005. I traded my own capital for 6 years, just, spending my own winnings, and realized quite quickly that even though I was doing really well and I was getting a killer return, every time you're pulling money out of a trading account, you're just spinning your wheels. So at that point I was like, well, I need a job. Like I need to make some money here to sustain this. I'm a great trader, but I'm not actually building anything here. So in 2012, I had to make the decision, am I just going to, go throw on a suit and tie and actually go on Wall Street and try to get a job there and then do my trading on the side? Or am I going to try to make my trading my actual job? And of course, what I decided. I made my trading my job. 2012, I launched. But I've been trading these strategies since before we officially launched the subscription in 2012. I had a website called VIX Trader in 2009. I was just posting the results and writing articles for free. I wasn't charging anything. And so in the first 3 or 4 years, incredibly heavy backtesting, just like hours and hours every single day. It was all backtesting. That's all I had, right? But then over time, you start having backtesting and live trading. And then you start learning about things. And now, 17 years later, I'm at the point where, sure, I still do run the backtest, but there's a lot of things in my head that I just absolutely know exactly what the results are going to be without running the backtest. But that wasn't the case when I started. So if you're asking this in the case of, I want to learn how to do this, yeah, I've told this story before. Starting my business, I gained I don't know how much, 15 pounds, right? It was the fattest I'd ever been because I'd go to Starbucks, I'd get a caramel frappuccino, and I would just backtest, right, for 3 hours straight. And then I'd go to Subway, and then I'd go to another Starbucks, and I'd get a frappuccino, and I'd 3-hour session in that Starbucks, and then I'd walk to the other Starbucks. There was like a triangle of Starbucks / Subway in my neighborhood, and I used to just do a big lap. I'm out for 10 hours backtesting and drinking 600-calorie drinks. And yeah, it was crazy, but I started my business and, slimmed down a little bit, and it's all good. But in the beginning, it's backtesting. And then you start to have a combination of then it's very educated, sort of directed backtesting. And then you get to a point where it's all live trading. I've been live trading these strategies for maybe not exactly the same, but like I said, anywhere from 15 to 20 years. I kind of know what they're doing now. So, but yeah, when you start trading, data is everything. Backtesting is everything. Record everything. Trade as much as you can, as small contracts as you can. Small dollar stuff, high volume, high trade frequency, record everything, analyze it. It won't take you more than 3 or 4 years before you've got an entire database of education to fall back on. And then you'll get to a point where you don't need to backtest anymore. I don't do a whole lot of backtesting other than to prove my existing strategies. Like our friend up here is saying, well, what if you replace IYR? I already know what it is, but I'll go ahead and do a live stream and show that for other people. But I don't actually backtest much anymore. Don't need to. Okay, ORR is a great long short single stock fund. Look into it. I will. I love recommendations like this because I've had plenty of good recommendations from people in the live chat In fact, I do remember it wasn't, I mean, it was a while ago, but somebody, I would have probably stumbled across Chaos within a few days anyway, but somebody told me about Chaos, how it was going over from, a previous fund into an ETF package. And yeah, cool stuff like that happens. And most of the time it's something I run the numbers and I look at it and I'm like, no, I don't want that. But occasionally it's a good one. So ORR, I will look into it. Yes, I have tested this. I should read it for people who are just listening. Have you backtested SPY versus Mag 7 or just SPY's heavyweight allocations? I've done every combination of all of it. So, the Mag 7, the top 10, I've done the S&P low vol, the S&P high dividend, the S&P, all the various, whatever. And I have chosen what I believe to be the best risk reward performance of all of our ETFs that we use. There is a reason that those are the ones that we use. The reason is most of the time drawdown reduction, because there is certainly a way, as long as the market cooperates, I could ramp up our portfolio performance to a really high level, right? Obviously using leverage, but just using things like you're saying. I mean, there was times when if you just simply replaced SPY with Apple, I mean, you can imagine if you started doing things like that, how good results could get during the good times. But then there's also times when it totally decouples from the market and you're like, God, I wish I wasn't in I wish I was just in the index, right? The index is way better than the individual stock. So I have chosen, basically, if you just take a snapshot of all the things that we are trading, there's a reason why we're using all of these assets. There's a reason why the thresholds are where they are. There's a reason why, this one, for example, uses cash on the low end. It just adds a level of diversification. You don't want to be long vol across the board because sometimes you're wrong. Sometimes there's whipsaw. So this one will be in cash. This one will be in chaos. There's a reason behind all of these selections. And I have, I've run through the numbers of thousands, right, at this point, individual stocks and ETFs, thousands of them. And as it turns out, for trend following strategies, when you are hyper conscious of drawdown reduction, indexes are typically your friend, right? Most people, they chase those shiny objects. They think, well, God, I wish I would have made this much if I just bought this. They're not seeing how much you would have lost every time it didn't go your way. It's my job to do those things because, like I said, VTS is my money. All my investable money outside of my homes is in my portfolio, pretty evenly split between VTS and VTS options. I cannot afford to take big drawdowns, and I don't need to, right? Like I said, we've done better than 15% a year significantly, but we don't need to. 15% a year forever is enough money that if you're living below your means and you're saving money, you're going to retire multimillionaires easy, right? No problem at all. 15% is a world-class rate of return. It really is. Maybe not in a 5-year bull market, but stretched out over 30 years, that is world-class. There's very, very few asset managers starting in 2025, going to 2050, will be able to achieve 15%. It'll be a very, very difficult task. So, wow. Long rant there. Yes, tested it. Check. All right. Every live stream, I have to say, I'm making slow progress. What's your best guess for restarting the VTS Options Academy? Okay, I answer this all the time. So the issue is, because it's a lifetime subscription, I'm not planning to do the whole thing where people, they launch a course every 3 or 4 months. You need this one, and then, you need the gold package. That's going to be amazing, and that's $700. And then this one, you join this Discord, and it's a little more money. I'm just going to have one price. People pay it, and it's just member for life. And there's only one community. I just think, sure, with marketing techniques and ad reels and things like that, you can make a lot more money if you sell 10 courses stretched out over 3 or 4 years, and you just individually pump them all. I don't care. I just want to simplify everything. So technically speaking, I could launch with like 2 strategies. I could do that. But in my head, I kind of wanted to get to 3 completed course videos. And so what I might do, and I'm speaking out loud, so don't hold me to this, but maybe do a like soft launch for just VTS, like anybody who has at some point touched VTS, either a free trial or a current subscriber, just do like a soft launch for them that is not quite to the level of the final product. I could do something like that. I don't know. Slow, steady progress, though. It's a lot of work because we did have the options community for years without the courses underneath it. And we had about 600 followers. So it was popular. But all I was doing was just sending trades out every single day. And then I would get a whole bunch of people asking, well, okay, what about this? What about that? What about stop losses? And I'm like, God, I don't have 5 hours to answer these emails. So now what I'm going to do is I'm going to build the course library underneath it and then send out the trades and people will understand what I'm talking about. But maybe it's just me, but making videos takes a long time. It is really, really time consuming. And slow, steady, chipping away at it. No estimation of date. It won't be that long. We'll see. My question was spread over 3 entries, but you just read the first one. Well, I do that sometimes. For the strategy that uses SPY during safe, how about selling? Okay, got it. Immediately on signal and have a buffer of a day or two to see the signal is lasting. Well, you're going to, I mean, it's 50-50, coin flip. Sometimes it lasts, sometimes it doesn't, but that's a net zero. Like there's no edge there. I don't mean to belittle this. I'm trying. By the way, instead of SPY, one can use SPY M, which is cheaper on a per unit basis. What you will find, and I did the same analysis for GLD and GLDM, it's the same, right? The ETF market, it is surprisingly efficient. Some people say, oh, why don't you use that fund? It's cheaper. The fees are cheaper. The fees are included and packaged in it. And what you will find is they're almost always exactly the same. So it might look like the management fee is a little bit lower, but then you plot them both and you include all the dividends and everything along the way. Maybe one of them is slightly worse, but then it's got a lower management fee. So I'll plot it on a curve. It's actually exactly the same. The lines just line up. There is very, very little edge in the financial industry at the institutional, like ETF level of just saying, oh, I can build the SPY and I can just make lower fees and mine's way better. It doesn't really work that way. So I'm not denying this. I guess I should probably run the numbers, but my guess is it's quite literally just a rounding error at the end of the day. And then there's also reasons why, if there is a difference, there's a reason for that difference. It's just not always obvious on the front end. But as to your main part of the question, whatever you do, you are doing something that has a reverse exposure to the other position. So you're holding SPY and you're selling a covered call. The higher that goes, the worse that cover call gets. You're kind of screwed anyway, right? So there is no situation where you can do this and it will have nothing but upside and no downside. Wouldn't that be great? But it doesn't work that way. So long term, you're capping your gains. You're not reducing your downside more than the tiny little premium. And again, you got to remember that this might be different if it was somehow reversed, but when are we in the SPY? Well, we're in the SPY when implied volatility is very low and option premium is very low. So you're selling your option premium at basically the worst possible time. If this was somehow reversed and you were like saying, well, this isn't really an ETF you could do, but if we were holding something here where, for example, it was a ETF with good options liquidity, well, maybe at that point you could say, well, because the option premium is so juiced, maybe then we would come in and we would, sell some put options on the reverse end. But no, like when the market is just trending higher in a low volatility squeeze upward, there's nothing there. Like you're just picking up pennies, basically. Not in front of the steamroller because, of course, it's a covered call and we are going to sell the position and exit to safety. So it's not like cataclysmically bad, but it's just going to reduce your performance. Again, I would challenge you, please, I hope I'm wrong. Go find me a buy right strategy that Wall Street has put together that has a reasonably long track record that's actually good. The marketing material sounds incredible, right? Why wouldn't you sell something that you own, right? You're just leasing out something you already own. Why wouldn't you? It's just free money. Or the thing that people will tell you when you're selling put options. Why wouldn't you sell put options? If I'm comfortable at that price, why wouldn't I just sell a put option on Tesla 30% out of the money? I'm comfortable holding Tesla 30% if it drops. This is the marketing, and it sounds so intuitive. People are like, yeah, why not? But then the market crashes and they realize immediately why not. And it's the same on the covered call side. Sounds like you're just leasing out something that you already own. You're just renting out your rental property. But what you're actually doing is you're cutting your potential gains at the time you need them most. We need those 3, 4, 5 week really explosive run-ups to offset the times that the signals get it wrong. We do have losing trades. We do have losing stretches. We have whole losing years. 2022 sucked. I need good periods to make up for that. The last thing I want to be doing is selling covered calls. I probably misunderstood your question, but that's kind of the best I could do there. All right, last question. If there anything ETF that collects stocks that freshly added to SPY or to QQQ and keeps some 25 or 40. All right, is there any ETF that collects stocks? The freshly added is throwing me off. That freshly added to SPY or to QQQ, to an index, and keeping some 25 or 40. Help me out. What am I reading here? I don't know. Gonna have to punt on this one. It sounds like an interesting question. The freshly added and the 25 or 40. There's something there. I'm sorry, I'm not getting it. Apologies. There's a Barclays report about squeezing vol premium from retail degen traders. There's always those. There's been articles about that since, the options market launched. What I would say is, there isn't any giant conspiracy that the institutions are using us and manipulating the market so all of us little peons in the retail space it just doesn't work that way. They are giant shipping containers, like those ships that carry the shipping containers. Then we are little speedboats. Our edge comes in the fact that we can exit to safety. A lot of people will say, well, you say you're so good with VTS. How come your performance is so good and nobody on Wall Street can beat you? Well, maybe because everybody on Wall Street can't just decide on Monday to sell their entire portfolio and move into cash. Maybe that's why, right? There's a number of reasons why I'm better than the hedge funds, but that is one of them, that institutions are playing an entirely different game than we are. So we have to stay in our lane and they can stay in theirs. I don't try to compete in their game. I don't try to arbitrage anything. I don't try to do any, we can collect the fees here and we can short this one and long that one. And actually we can arbitrage the difference. That's the big institution game. They can do that. High frequency trading can do that. It's not our game. We have to play our game and they can't compete with me. They can't compete with us in the community because we're small. And that's a huge, huge advantage. So again, there's been stories like this. It's just not true. First of all, the vol space is relatively small anyway, but also, no, it's just, there would be no reason to be doing any of this stuff. You can just make the general assumption that most of the activity in the options world is fairly sophisticated traders. So the idea that there's like degen traders to be taken advantage of is a little bit, maybe it's true if you're trading like, what is it, GameStop? Maybe that's true. But if you're trading options, now you're talking about a more sophisticated audience. Then you're talking about volatility and volatility ETPs and VIX related derivatives. Yeah, there's no more degens there. They pretty much, if you are, then you're in the wrong game because that stuff gets confusing. So since COVID, it's not the same players. I don't know what you mean by this. I would assume we're actually probably in agreement. We're just talking past each other because I'm not really understanding your point. But I'm not one of those people that think that there's this giant manipulation and like, JP Morgan is stealing all our money. But even if that was true, I'm also not the victim mindset. I'm like, okay, fine. Let's say that is true. Let's say everything is being manipulated. Well, I still have to play the game. I still have to play the best hand I can, right? You have to take the markets as they are. I don't believe that I'm being played by the puppet masters, but even if I was, I still have to invest my capital. So I just have to suck it up and deal with it. Whatever, I don't care. I don't mean your question. I mean, I don't care. I don't get distracted by things I can't control. Little golf analogy here. I always like to do little golf tangents. And when I was playing, professional golf and playing my best, there is a billion distractions you can imagine. So I used to do this thing that I would call my bubble. And I would, in my brain, so I have a kind of a visual brain. I'm one of those people that you see the thing, like if I say apple, can you see the apple? I can see the most vivid apple in the world. Like say pink elephant. Can you see a pink elephant? Half the population can't. They can kind of imagine, pink elephant. They might be able to see the letters, but some people can't see a pink elephant when you say those words. I see like just like an artist's description of a pink elephant. So I'm very visual that way. And so in my bubble, when I'm walking down the fairways, when I'm walking up to the green, when I'm reading my putts and I can hear people talking and cameras are snapping pictures and I'm nervous and my sponsors are upset because I missed the cut last week and my foot hurts because I went out running and I twisted my ankle. There's a million things going wrong. But in my bubble is only the things I can control. And everything else gets thrown out of the bubble, right? So I would literally even be walking down the fairway sometimes, and people in the audience or in the fans would tell me after the round, like, what were you doing with your arms on that hole? I would be literally just taking things and throwing them out of my bubble. Like I would notice a camera and I'm like, God, I want to yell at that guy. What is he doing? Like, doesn't he know I'm working today? And he's distracting, but what am I going to do? Am I going to go fight the guy? No. So you got to take that and throw it out of your bubble. And everything that is not in your direct control has to be thrown out of your bubble. Because if it's not, you're going to go down every single rabbit hole. You're going to be going down the JP Morgan is doing this to the silver market. Oh my God, we can't compete. And then all these things, they're doing it to the crypto market and they're rug pulling all of us. And Michael Saylor's doing this. And you're just never going to have success if you're not able to only focus on what you can directly control. That's the whole game. So take whatever I fully acknowledge I'm probably misunderstanding what you're saying, but whatever you're saying, that's over there. I don't care. If somebody's trying to pull the wool over my eyes, cool. I'm still going to win. That's the attitude. Maybe manipulation, maybe not. Was saying zero TD and highly convex options have been squeezed from retail degen trader, according to Barclays. Well, I will agree with you that the market dynamics are changing, and a large part of that change is the switch to zero DTE and very short-dated contracts. This is true. As far as whether it's like manipulation or unfair or something I personally have to worry about, no. That's over there. That is not my concern. I just take the market as it is today and I do the very best I can, control my controllables, forget the rest. None of the rest matters. That applies to everything in life. Life is so much better and your success amplifies and accelerates so much quicker when you can just focus on what you can control and you can actually throw everything else out of your bubble. We don't need to be slowing ourselves down with things we can't control. We don't need to be laying in bed at night thinking and worrying about things that we can't control. We don't need to be worrying about what other people are saying about us because I can't control that. None of these things are going to make me a better person. And I don't mean to get all philosophical on you here. I'm sure you had a specific point, but just in general, yes, market dynamics change all the time. There's nothing special about 2025. You go back into the DeLorean time machine to 1983, and those traders will think that something special is happening in 1983. That's what they're going to think. We always think that we're in the change. Like it's different this time. No, it's not. It's not better. It's not worse. It's just different. Markets change. We have to change with it. And hopefully we're a little ahead of it, right? That's the key. So we'll leave it there, a little philosophical there. But remember, if you can't directly control it, throw it out of your bubble. And if people see you doing this with your arms, let them laugh. It's actually very helpful. This is what you learn from sports psychologists as well. Physical actions to manifest visual things is 10 times more effective. So when I'm standing on the tee box, for example, my pre-shot routine was 17 seconds, starting with my left leg, take the first step. Everything is just a total system. But when you're standing there lining up, I'm literally watching the ball go the entire flight path before I pull the trigger. I'm standing at like a 10 feet above my body, staring at the top of my head, watching my beautiful, perfect golf swing. I can see it happen. I can see the ball happening. And my arm is literally going like this. Sometimes you'll see on the PGA Tour, if you watch them, you'll see them kind of half close their eyes and they're doing something, physical action. So whenever you see something in the market, you're staring at your screen and you're seeing the stock that you own going down, visual hand signals, and just go for it. You look like a crazy person, but it all works. Trust me. All right, cool. We'll end it there. I will see you all next week.